Most traders lose money because they trade on emotions, fear, hope, or impulse. But Jesse Livermore, one of the greatest traders in history, followed a strict system. He had a process for when to enter, when to add, and when to exit. Today, I'm going to walk you through his method step by step and show you exactly how he would build a $50,000 position without ever averaging down. Livermore always started by asking, what's the direction of the market? He only bought in a rising market and only shorted in a falling one. His golden rule was, the market is always right. If he wasn't sure, he stayed in cash, because for him, not trading was also a position. When it came to entries, Livermore never went all in at once. He believed timing mattered just as much as sizing. Here's how he looked for entry points. Breakout confirmation. Enter after a stock breaks through a key resistance level and holds above it. Not just a quick spike, but a real breakout proven by staying above that level. Pullback holding support. If a stock makes a new high, then pulls back slightly and finds support at the breakout level, Livermore often entered as it resumed upward. This showed strength and healthy demand. Volume as a signal. He wanted to see higher volume on rallies and lower volume on pullbacks. Rising price with strong volume was his green light. Round numbers and pivot points. Stocks often struggled at psychological levels like $50, $100, or $200. Once a stock broke cleanly above these levels, he treated it as confirmation of the next upward leg. Putting it together. Confirm the overall market trend is bullish. Look for a stock breaking resistance with strong volume. Enter small, a test position, right after the breakout. If the stock holds that level or pulls back and then rallies, add more. Keep building only if the market continues to confirm the trade. The key rule, add only to winners, never to losers. Exiting was where Livermore's discipline really showed. Cut losses quickly. Never let a small loss turn into a big one. Let profits run, ride the trend as far as it will go. And if the market moved against him without reason, he exited immediately. For him, the market's action was more important than his own opinion. Here's where Livermore stood out, his pyramiding strategy. He built positions step by step, but each addition was smaller than the last. This way, if the trend broke, he never risked too much at the top. And he never bet all his money at once. It was about scaling up as the market rewarded him. Livermore said the most dangerous thing in trading was not the market, but the trader's own mind. He kept detailed records of his trades, admitted when he was wrong, and avoided stubbornness. He knew discipline and patience were more important than any trading system. Let's put this into a real-world example. Suppose you want to invest $50,000 in a trade. Here's how Livermore would build it. Step 1. Start with 25%, $12,500, on a confirmed breakout. Step 2. If the trade works, add another 25%. Now you're in for $25,000. Step 3. Add a smaller piece, about 20%, $10,000, as the trend continues. Step 4. Add 15%, $7,500, when the stock proves itself again. Step 5. And finally, add the last 10%, $5,000, only if the trend remains strong. By the end, you're fully invested at $50,000. But every dollar was added only after the market proved you right. To sum it up, identify the market's trend. Time your entry at breakouts, supported by volume and confirmation. Start small and add only to winners. Cut losses quickly and let profits run. And above all, stay disciplined. This is why Jesse Livermore's strategy is timeless, even 100 years later. If you found this breakdown helpful, hit the like button, subscribe for more timeless trading strategies, and comment below if you'd like me to cover more of Livermore's rules in detail. Thanks for watching and trade safe.